Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Nebius. Q4 earnings are out, and they're okay. Pre-market reaction, pretty negative, down 12% or so after the call. I listened to the call, wasn't too exciting, but keep in mind that this is a stock that's up 47% year to date, a bit less after the pre-market reaction. This is a stock that went from 30 bucks at the beginning of the year up all the way into the 40s once people digested the idea that Nvidia was investing in this. Once people digested the idea that this was a pretty interesting business, it fell into the mid 20s. I picked up a bunch of shares during that period. This was because of the DeepSeek news that came out where a lot of these AI stocks panicked. After that, it started rising again. Nvidia released a form that said, hey, we actually invested in this for real, even though that was already known back in December. One has to remember, though, that Nvidia can buy and sell businesses at whim, and they only bought about 1 million shares of Nebius when they did their fundraise. They sold 33 million shares or so to raise 700 million bucks. Nvidia was a small part of that, but it's nice to have their support for sure. However, they also bought a company called SoundHound a while ago. That was a positive for that company, and they announced they just sold it, which sent the stock falling about 30%. So keep that in mind. If you're investing solely on the fact that this is an Nvidia investment, it still has to be a good business in order for it to be a good investment long term. And this is very much a new company. They just came out of the investing black hole around October. This used to be a Russian firm. They sold off the Russian assets. They used to be essentially the Google of Russia. They sold off their Russian assets and reemerged as the remnants of that company, their non-Russian assets, as Nebius Group, and have been growing since then. They have a few businesses, but their primary business is in the data center infrastructure space. I did talk about this company in more detail in my last video. I will link that down below, so check that one out if you want to know more. But essentially, this is very much in the initial phases of its development. Nebius has a couple of companies, but this data infrastructure company is its main one that investors are really excited about. They're growing really quickly. GPU capacity going from 20,000 in 24 to 60,000 by the end of 25 to more than 240,000 in the medium term. At least that's the goal. That'll drive pretty significant revenue expansion. And keep in mind that they believe that the total addressable market here is huge. 33 billion in 2023, growing at a CAGR of 35% until 2030. And you can see that in the investments that a lot of these companies are making. It's not just Nebius, it's a lot of the hyperscalers. You look at the capex expectations for 2025 for Amazon, Google, Meta, and Microsoft. Between the four of them, it's close to 300 billion, if not more. You have that Stargate program, $500 billion in investments in AI in the coming years. For OpenAI and other companies, you've got some European programs coming online, and that's definitely going to drive up the supply that exists, because right now demand for AI computing power outstrips supply by 2 to 2.5x, and that's really why these companies are driving so much investments in these GPUs, in these data centers. And right now that benefits a company like Nebius or any of these hyperscalers because they can charge quite a bit of money for that supply because demand outstrips it. What's going to happen in the long run when that supply really comes online? Will those prices come down, and will that really hurt the margins and the growth potentials of companies like these? That's the risk that you have to worry about. Right now, demand is amazing, but the supply is really coming online, and it's not just Nebius, it's CoreWeave, it's other companies like that that are putting that online, and you can see that in the growth potential here and the guidance here. This is going to be really interesting in terms of what we're seeing for the actual earnings release. They guided for 170 to 190 ARR for the end of Q4 2024. And actually, they didn't hit that. That's the one thing that I think worries investors. So let's take a look at these earnings really quick. So high level, the earnings look okay. 117 million bucks in 2024 revenue, and that's something to keep in mind. This is still a very, very small business. Like I said, you're talking about a $10 billion market cap business with $117 million in revenue. That's a pretty pricey multiple on a sales basis. It is growing at 462%, and that's a key thing. This is a business that is very much in the investment phase. They have 2.4 billion in cash to do those investments, but they're losing $300 to $400 million every single year, whether you look at it on an EBITDA basis or a net loss from continuing operations basis. When you look at cash burn, they're burning more than $1 billion because they're losing money, plus investing $1 billion plus in building out data centers and buying GPUs. That's why they already went and raised $700 million in 2024. That included that NVIDIA raise. That's going to help them be more steady, help them fund the next 1 or 2 years of investments. But this is not a 1 to 2 year investment cycle. They're going to have to spend $4 to $5 billion in the next couple of years, which will mean probably they'll have to raise more money, whether it's via debt or additional share issuances. That's really the reality you're facing as an investor here. Very much a newish business. It's going to grow really quickly because you can kind of see their guidance for ARR, which was under 200 million in 2024, is now 750 to 1 billion for 2025, and that's what they projected before. They're seeing that March is on its way to get there with ARR in the 220 million range, with more additional deals in the pipeline. And it'll be interesting to see if they announce any larger clients, because one of the key things that could drive the stock price up here is, hey, we've signed a deal with Google, or we signed a deal with Microsoft, and that's going to help us easily reach that 750 million to 1 billion ARR. What was interesting here, though, is for Q4, their ARR was actually missed. They had a December ARR that was guiding for 170 to 190. They actually hit 90 million below the previous guidance, which again, they blamed on losing some customers, longer lead times for customers that are making new deals. And that's kind of concerning when I look at that. It's like, yes, they got through that and they signed new contracts. Maybe those took longer to materialize, but seems like customers are becoming a bit more selective with the deals that they're signing. They're still getting there. Their March ARR is at 220 million plus. They're still aiming for the 750 million to 1 billion. But I think investors were hoping that they were going to say, hey, we're well on our way there. We're going to be closer to 1 billion versus the 750 million, versus just guiding to what they guided to before, with the addition of an actual miss in the guidance for December 2024. So they're still going there. They're still on the way to the guidance that they gave before, but there's some missteps on the way there, which for a company that's as early in its development as Nebius is a bit of a concern. It doesn't make me change my mind about this, but it does make me feel like I have to be a bit more careful about position sizing with a company like this one. I can't make it 100% of my portfolio, even though I really believe in it. Right now, it's probably closer to 6-7% of my portfolio. So we'll see how I look at it on a go-forward basis, and we'll look at valuation in a second. They talked about some of the things here. Hey, we're opening a cluster in Kansas City. We started one in Paris, France. And this is the interesting part about Nebius. They're based in Europe. Relations between Europe and the United States right now aren't the best they've ever been. So if Europe wants to invest in its own AI infrastructure, Nebius is right there. Maybe that's a benefit for them, because maybe they don't want to be dependent on the US-based hyperscalers like Amazon, Microsoft, etc., or CoreWeave. They want to do something in-house, and Nebius is right there. And is that a risk for Nebius because they're based in Europe? However, I don't think so. Again, this infrastructure stuff, it doesn't seem like it's going to be impacted by tariffs or things of that nature. And also, Nebius is developing GPU clusters in the United States as well, so they have both exposure to the US with US-based infrastructure and to Europe with Europe-based infrastructure, which is nice to see. And then they have the software layer as well, and I think this is the interesting part of Nebius, that they're not just a hardware company. They're a bit different than something like CoreWeave. They have the software layer developing sort of a full-stack infrastructure setup where they can have their own software running some of these things and charge for that, and develop this higher margin business that could help them eventually turn to cash flow positivity somewhere down the line. Then they have these other smaller software business. You've got Toloka, which is a model that's all about high quality training data for generative AI, growing at 140%, probably a $50 to $100 million business in 2025 on the revenue side. You've got Triple 10, which is an ed tech business, also in that like $50 million revenue range. And then you've got AV Ride, which is an autonomous vehicle business, which again doesn't really generate any revenue, but this is something they've spent $500 million on already. They're doing quite a bit of autonomous vehicle testing on public roads in South Korea, starting to do a lot of delivery robots in Korea, Japan, the United States, partnerships partnerships abound. So I think at the end of the day, are these businesses contributing a ton to the overall value of the business? No. When I think about this business in the future, it's mostly this Nebius software slash infrastructure layer that I'm interested in. But you've got Toloka, you've got Triple 10, you've got AV Ride as sort of these call options on other businesses that they can eventually sell in the future to raise money to build out more infrastructure, or they could IPO on their own because, again, autonomous vehicles could be something impressive, could be nothing. But at the end of the day, I'm not depending on these businesses to do anything more than provide some potential upside versus what Nebius is, which is mainly an infrastructure play for me. So how the heck do you value something like this? And disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Nebius is an AI hyperscaler. Essentially, that's what they're trying to be. And you've got a comparable in CoreWeave. CoreWeave in 2023 was valued in maybe the low billions, had a couple $100 million in revenue, was growing really quickly. And then in 24, this is a $2 billion a year revenue business, valued at $23 billion all of a sudden. In 25, looking to IPO sometime soon, probably close to an $8 billion revenue a year business. IPO potential in that 35 billion range on a market cap basis, closer to 45 billion range on an enterprise value basis. That's kind of your pathway for Nebius. Nebius right now, kind of where CoreWeave was maybe in 23, maybe even in 22, growing really quickly, but not much of a business right now. Execution has to be there for sure. But Nebius, you've got a $10 billion business. What's the potential for it? Can it be a $25 billion business like how CoreWeave was when it reaches $2 billion in revenue sometime in 26, 27? I think so. Can it be a $35 billion business a couple of years down the line? I think so. So when you look at it that way, your starting point is $10 billion. They're going to do some dilution. You're looking at a doubling or tripling of the price. If you simply follow the path of CoreWeave, then you have the potential upside of some of these other businesses in AV Ride, in Toloka, in Triple 10, the software business that they're developing on top, the full AI stack. That's kind of how investors are looking at it. If you want a simple way of looking at it, if that's not enough for you, here's another valuation-based way to look at something like this. So this is the reality of how I'm looking at this business and kind of the expectations I have for something like Nebius and where they have to go in order to make their valuation make sense and give you a pretty significant target return here. You're going to grow at 300% in 25. That's pretty realistic. That's kind of what they're guiding for based on the 750 million to 1 billion ARR by the end of the year. Then that's going to lead to pretty significant growth into 26. You're going from 500 million in revenue, shy of that, to 1.2 billion. Another 100% year in 27, another 70% year in 28, and then that 45% year in 29. The idea here is that you're going from 30,000 GPUs to 240,000. You're keeping the demand supply about where it is today, maybe getting slightly worse. The pricing dynamic doesn't change too much. And you're getting from a $500 million business in 25 to a $6 billion plus business in 29. The first couple of years are going to be cash burn businesses. You're going to be maybe EBITDA positive by the end of 2025, but you're still investing $1 to $1.5 billion in CapEx. That means you're probably going to burn anywhere from $4 to $5 billion in the next 4 years. That means you're probably going to have to raise some money. I've got negative $1 billion in stock buybacks, meaning that they're diluting shares to raise money. They're probably going to have to take on some debt as well. That's kind of the idea behind this business. You're investing a ton in future growth with the idea that eventually you're going to turn cash flow positive. Now in 29, when they're a mature business, I have a free cash flow margin of about 12.5%. And that seems relatively conservative to me. When you talk about some of these hyperscalers, whether it's CoreWeave or Amazon or whatever, you're talking about gross margins that are anywhere from 65 to 80%. You're talking about EBITDA margins probably in the 30 to 40% range, which means free cash flow margins somewhere in that like 20 to 30% range at maturity. So they're not quite anywhere close to maturity at in 29, but they're sort of getting there. So when you get to that spot, when you're actually making money, you put a pretty conservative 4% free cash flow yield on here. You're talking about an expected return of about 11% from a $44 price point. And I think this is all relatively conservative because that only puts you at a $20 billion market cap, well below where CoreWeave would be at a similar revenue. It all depends on how the market prices AI 4 to 5 years from now. That's the risky part of this sort of analysis. Is AI going to be in vogue then, or is it going to be kind of out of the public realm? Is it going to be as exciting as it is today where all of these AI plays are getting pretty significant multiples, or is it not? At the end of the day, in 29 or 30, or when this business is mature, this does have to start supporting its own weight in terms of free cash flow generation. And when that happens, what's the mature free cash flow margin? 12.5%, you're talking about 11 to 18% returns from a $44 price point. What about if you get to a 15% free cash flow margins? You start talking about 16 to 23% returns. What about if you're really good as a business, the software business is clicking, your demand supply is the same, and you're still charging a decent amount for GPU compute per hour, you're talking about 20% margins. Then you start talking about this 20 to 30% annualized return, maybe even higher, because these are 43% free cash flow yields on a business that's still potentially growing in the 20% plus range, which might be conservative. But then you're getting to the $100 to $170 price point for this stock, even with some dilution. That's where it gets exciting. That's when you start talking about, hey, the fair value of this business based on future potential could be, in the mid 60s right now. Yeah, if you're conservative, it's probably in that like $30 to $40 range, which is where I was a buyer, which is where I'd be comfortable buying it, because then you're targeting a 15% return. You have some margin of safety, because the downside here is pretty significant. If the demand supply thing changes, if suddenly GPU compute per hour is much lower than the $4 to $7 they're able to charge for that today, this price could come down substantially. They do have to execute well. There's execution risk. They have to grow a ton. You're expecting, 300% growth, followed by 170% growth, followed by 100% growth, followed by growth in the 70 to 50% range for years to come. That's the thing you're looking at here. You're looking at pretty significant growth for at least 4 to 5 to 6 years. You're looking at free cash flow positivity probably within the 5 to 6 year mark. And that's what you're expecting if you're a buyer at today's prices. Are you comfortable with that? Are you comfortable with the execution risk? Are you comfortable with the fact that this business is $100 million in revenue now, and you're expecting it to be $6 billion in revenue by 2029? That's the reality of the investment you're making. That's what you have to be comfortable with. Personally, this was a speculative investment for me. That's what I called the first video, new speculative play on me. And this is still speculative for sure. The idea that they're going to hit $500 million in revenue in 25, I'm kind of on board with that. But after that, it's very speculative in nature. You have to assume that their investments are going to pay off, that there's going to be investments by some larger corporation in Nebius supply, or some of these countries in Europe are going to say, we need to really develop in-house AI infrastructure, and we're going to help companies like Nebius do that. They're going to continue doing business with American companies, building out data centers in America. A lot of risk with all of that. I do think the management team here is solid. They built out Yandex from nothing to make it a $30 billion business in a relatively small market. Now they're targeting the entire world. The potential for AI to be a huge thing is massive, and that's the investment you're making here. They talked about how, hey, we have this 240 megawatt potential in the medium term. There's been talk, the CEO has mentioned that in the long term, they could be at a gigawatt of data infrastructure that's out there. This could be a tremendously large business, and you're investing on the relative ground floor. It's not cheap by any means. It's already being priced at 10 billion in market cap, close to 8 billion in enterprise value. They're going to have to raise money via debt or share issuances. They do have some stock-based compensation. There's going to be some dilution, and there's the execution they have to deliver. That's how I look at the stock. It's speculative for sure, but the potential upside is huge. Let's say they go to a 22.5% free cash flow margin when they're a mature business, which the hyperscalers do. You could be getting a 20 to 30 to 40% annual return from the $44 price point if things go well. That's the risk, though. That's the risk with investing. This is very speculative. This is not a Walmart when you know where the free cash flow is going to be 5 years from now, where the revenue is going to be 5 years from now. You have a pretty good idea. Here, you're just throwing a dart at hoping that it hits, but the management, their business plan, the addition of the 2 software businesses, the autonomous vehicle business, there's some holdings of ClickHouse they have that's worth something. That adds to it and makes it a bit more interesting. That's why I'm interested in this stock, because the upside could be, 30% plus annual returns from today, and the downside is significant. If execution doesn't work out, this stock's going to go well down the drain. So again, keep that in mind. Position sizing does matter. And as always, guys, this video is not investment advice. So let me know what you think. Am I wrong? Am I missing something on Nebius? I mean, I like it, but I know it's risky. So that's why my position is relatively decently sized, but not too much so that it doesn't blow up my portfolio. What do you think about this one? Leave a comment down below. Like, subscribe, and all of that good stuff. And as always, thanks for watching. Bye.